Thank you for joining us for this week's M&A Access, the official podcast for the Alliance of M&A Advisors. My name is Gina Galusha, and I'm the Executive Director of AMA, and today we have a great topic for you to dive into. Led by Vice Chair of our Advisory Council and a Managing Director at 414 Capital, Lindsey Wendler weaves together a great story on how tariffs and taxes are affecting M&A and the next market cycle. Between the double down on tariffs and the big, beautiful bill, her distinguished panelists have some really great tea on what's coming for M&A. Take it away, Lindsey.
Hi, everyone. Thank you for being here for taxes, tariffs, and transactions. I have an amazing panel today, so I'm really excited to get started. So to kick things off, we will do some introductions. So to start, I'm Lindsey Wendler. I'm a managing director at 414 Capital. We are a middle market investment bank, and we have three main areas of focus. We do M&A, buy side and sell side, where we've closed over 300 transactions since 2009. We have a valuation division, which primarily works with funds. We work with over 150 funds and value over 900 assets quarterly. And we have a private placements group that's raised nearly $20 billion for private funds. I mostly work with family and founder-owned businesses that are 20 to 200 million in revenue across a wide array of industries. And now I'll let Ryan introduce himself.
Good morning. I'm Ryan Broyle here on behalf of Northern Trust. We're a somewhat specialized wealth management and custody and institutional bank. Thank you to anyone who has done business with Northern Trust. I couldn't be here without you. We're headquartered here in Chicago, where I'm based, so welcome to my hometown. My role is Chief U.S. Economist, which at Northern Trust is a risk management position. So I get to do some fun stuff. I get to come talk on panels like these. We write a weekly commentary, a monthly forecast you can find on northerntrust.com, but it's also a risk role. And part of my job is to think about the scenarios. What are the upsides, but really what's the worst that can happen? We lead the stress test to make sure Northern Trust can survive another 2008 or 2020 type event. So as we think about what's the worst that can happen, I can assure you it's been a busy year for me.
Thanks, Ryan. Good morning, everyone. I'm Dean Peterson. I'm the managing partner of the international tax team at EisnerAmper. EisnerAmper is a New York-based accounting and consulting firm with 66 offices around the country. We focus on middle market transactions. We focus on middle market clients. With that said, we'll talk to an entrepreneur. We'll also talk to multi-billion-dollar companies as well for all of their tax planning, and even tariff planning needs. One of the busiest times of my career is right now because we're facing things such as the one big, beautiful bill and tariffs at the same time. So my phone is absolutely ringing off the hook right now, and so I'm very excited to share some insights with you today.
My name is Aaron Pinegar. I'm a tax partner at a firm called Jackson Walker. If you're not familiar, Jackson Walker is a Texas law firm. We're the largest law firm in Texas, just crossed 500 attorneys a couple of years ago. Offices in all the major markets in Texas. I spend 90% of my time doing M&A deals, both with my own firm and also with other attorneys at other firms that are kind of smaller firms that need somebody like me and don't have them on their staff. So I'm spending a lot of time doing deals all over the country, helping people in really interesting industries that I wouldn't naturally get in Texas, but kind of makes it fun to be working with some people at other firms as well.
Gregory Wilder. My firm is Wildflower Legacy and Wealth Planning. It's a CPA and a tax law firm. I'm the owner and founder. I spent 30 of my 42 years in practice running regional and national practices for big international accounting firms, Arthur Andersen, Grant Thornton, and BDO. And during that time, what I continue to do is mostly focus on exit planning and high-end estate, multi-generational estate planning, typically for sellers, everything from middle market businesses like Lindsey and Aaron talked about to professional sports teams and everything in between. So anything involving big gains or big values, that's what I deal with for a long time now.
So maybe to set the lay of the land, Ryan, I'm sure you've had a lot to digest when it comes to trade policy. Can you recap what got us here, where tariffs stand, and how you think this will end?
Yes, I've had a question or two on trade. And this is a recorded session, and I hesitate to get into too many details because it is rapidly changing. After a bit of a lull, we've got more news lately. Let's take a step back. One important lesson I've learned from my colleagues in asset management is that markets don't sell off twice due to the same shock. We tend not to get scared twice for the same reason. So why were we caught off guard in April? Why was there a sell-off? Because we've already had a President Trump. We have seen tariffs before. This was a cornerstone of his first term. But as we looked back, we could see, okay, we got some deregulation, we got some tax cuts, and yeah, he picked some trade wars, but ultimately got to some deals, and where we saw tariffs, they weren't that bad. Up to 25% on China, proved to be livable, didn't really change much, so okay, he'll do some more tariff stuff, but that'll be fine. And what we've seen in the second term is really not comparable to the first. He's coming on strong, really aggressive, not limited to matters involving trade. The first big tariff action was related to fentanyl and migration. We're seeing this again intervening in Brazilian politics. So he's taking tariffs to their extreme for any possible purpose. Now, we saw a real ramp up. First with the fentanyl and migration stuff, then steel and aluminum came back, which could have come back anyway if we had a different president. Those were scheduled to sunset. New tariffs on autos and auto parts, that's big, that's kind of damaging. And then the big one was the reciprocal tariffs plan at the start of April. Those went into force on April 9th, and I was really afraid for how well the economy could stomach that. It looked like we were heading into recession. 12 hours after they went into force, Trump deferred them, 90 days. And a lot of the news following that was toward finding deals, deferring 90 days. China went to 145%, then back down to 50. Okay, Trump's backing down. And then we heard this acronym. We've all heard TACO now. Trump always chickens out. It's clever. Everybody likes a good acronym, but I don't like the concept, especially the A, the always, because he backed down on reciprocal stuff, but everything I mentioned initially, that's still happening. The steel and aluminum tariffs, they're in force. They got bigger, and now we're adding copper. Autos and auto parts, we're not backing down, and that's deferring, getting in the way of any sort of other agreement with other countries because we won't back down on the auto tariffs. So if we're careening into recession, he is listening to the bond markets, that's important, but right now he's not getting any feedback. I think we're getting a little too complacent with this idea, okay, yeah, August 1st, whatever, he's gonna back down, we're gonna find some deals. I'm not so sure. He backed down once because bond markets were selling off alongside equities, and he knows that's a problem. If we don't see a market reaction, what incentive does he have to change course? So I don't know exactly where this ends. I wish I knew when it ends. It's obviously not getting any lighter. We came into the year at a 2.5% average tariff rate. We're currently at about 13.5%, and it's going higher. Some of these threatened tariffs are going into force. We're looking at 15, 16, 17%. That's a lot for markets to stomach as it is. And then there's a persistent cloud of uncertainty that there could be more coming. So I guess the next big date is August 1st. I hope that just ends it. I hope we can get to a streak where we just don't escalate, but clearly Trump likes tariffs, and he will continue to threaten them, and I don't know how we ever quite get past that. As we have to price it in, they're bound to be inflationary. They're going to they're just a new cost. They're a tax on imports paid by the importer, has to get absorbed somewhere, whether that's by the exporter or cut into margins or flowing through to final prices. We're starting to see some effects on final prices. Just the initial hints of it, it's probably going to be an ongoing story. And that's just the uncertainty, in addition to the inflation, is going to slow down the growth outlook. Not that we're heading into recession, just that uncertainty is weighing on all of us. Hope that helps.
And are the rest of you guys seeing this uncertainty kind of unfold with your own clients? And if so, how and how are you dealing with it?
Yeah, absolutely. We're seeing our clients asking us a lot of questions about what's coming next. When are tariffs going to be settled? What are the interest rates going to look like? Because the one thing that's always going to ring true is investors like predictability. And this is not a time where we can predict what's going to happen next or when the dust is going to settle. So we're telling a lot of our clients right now that we're going to have to wait to do any real tax planning for them until we understand exactly what the final trade policies are going to look like. Because clients are looking at their supply chains and wondering, how can I avoid tariffs? How can I avoid higher interest rates, et cetera? And we just can't advise them in good conscience right now to do much other than wait.
Yeah. So Ryan, there's certainly been some vocal pressure on the Fed to cut interest rates. What's your outlook for interest rates ahead?
Sure. So set aside any political pressure, as the Federal Reserve promises they're doing. They ignore all that feedback. They do their best to place it out of mind. You can still make a case that the next move is a cut. The Fed has a dual mandate: maximum employment and stable prices. And through this whole cycle, they really haven't had to worry much about the labor market. We got down to, 3.4% unemployment. Labor market's been strong. It is cooling now, but getting more toward a normal, steady state. It's just not overheated. I wouldn't say we're in any trouble. So they have to worry about inflation, which has really recovered from where we were in 2021 and 22. What did we peak at? 9% CPI. It was, we were worried it got up to 2.7 yesterday. It's so much better, but it is higher than we were accustomed to pre-pandemic, and it is above the Fed's 2% PCE target. We're sort of stuck in this range for the past year or more of 2 to 3% inflation. We'd like to see it lower. We don't want to see it take off again. Plus, you have this risk of the cost of tariffs increasing goods prices. I would say the worst case scenario didn't happen. There was not an immediate price shock, but we do have to worry about that compounding price pressures, and that could add to it. But as long as things stay stable enough, everyone on the Fed says we're in restrictive territory. We should cut. So the next move is a cut, absent any sort of crisis, which I just don't see inflation taking off again in a big way. We think September could be the next move, setting aside all the commentary, all the feedback they're getting from the White House. We think after that, maybe 2 more cuts, but this cycle is close to done. Inflation is stuck just a bit higher, but based on their mandate alone, they can make a case for cutting and hopefully cool things down. Now, Trump is calling for 2 to 3% percentage points cuts, and I'm talking about quarter-point cuts. So whatever they do, they're going to get some vocal feedback, and I think they'll continue to set that aside. And we'll get a new Fed chair next year. Will be subject to the same forces. The Fed chair doesn't control inflation, and the Fed chair alone does not control rates. It's a committee that makes decisions by majority. So even if you have a real iconoclast, a real outlier of a Fed chair, that person can be overruled. So I'm not too worried about political pressure on the Fed at this time.
Well, maybe before diving into the one big beautiful bill, we can go with one more question for you, Ryan. What are the macroeconomic indicators you're watching which might be a sign we may be entering a new cycle?
I'd say first and foremost, labor. That's been the story of this whole cycle. If it feels like we've been through a lot, we absolutely are enduring a lot, but really give yourself credit for these past several years of massive uncertainty and this feeling that a recession was imminent in 2023 and 24. We've never been through an inflationary cycle that didn't correct with a recession. It's inevitable. And I say with some pride, at Northern Trust, we never put out a recession forecast. Ours weren't perfect either. We undershot. It was a better cycle than we anticipated. We just didn't think negative growth. All came down to the jobs market. As long as people are working, we keep spending. As long as we keep spending, the economy keeps growing. So I'm looking for any cracks in the labor market, and it's just not appearing. Again, the hard data and soft data are diverging. Maybe we could see better balance in terms of job growth, but it's been fine. Every Thursday morning, initial unemployment claims. That's a great real-time indicator. If people are laid off, they file for unemployment. You would see something breaking there. It's just not happening. Continuing unemployment claims are a little high. We'd like to see more hiring, but that's about my biggest grievance. So there's a hint that things are still steady, and if something's breaking, it's going to come through the labor market. Keep an eye on some policy-affected sectors. We're talking a lot about trade, but spare a thought for healthcare or higher education, tourism. But again, nothing's really broken yet, but those are sectors that I'm keeping an eye on for now. That said, there is upside risk. Risk runs both ways. So we have, as you've alluded, a new fiscal package, new set of tax policies, as well as a more restrictive trade regime that should promote reshoring, should promote domestic production. So we could be on the cusp of a new CapEx cycle, and it's worth seeing what happens with business investment there. Maybe we'll see some new growth unlocked, and with it some new hiring, and with it more confidence in my outlook.
Interesting. And you mentioned it should boost manufacturing. Dean, we were talking earlier, your practice is very international, and I think it'd be interesting to hear your perspective from your international clients. Is it really boosting manufacturing? What are you seeing?
So right now, I still think it's too early to tell. I am not seeing a lot of my U.S. clients flocking back to the U.S. with their manufacturing. They're still taking, as I noted earlier, a bit of a wait-and-see approach to see where some of this ends up with the tariffs. I'm not seeing my international clients moving to manufacture in the U.S. if they have large U.S. market share. But I believe that's going to happen. You know, the goal of a lot of these, the tariff policies as well as the one big beautiful bill, is to increase domestic manufacturing. That's a long-term goal. That's not something we're going to see in the short term.
All right, so how do you guys expect upcoming tax policy changes, whether state or federal, to shape deal volume and structure decisions over the next 12 to 24 months? And this is largely playing off of what we are now seeing in the One Big Beautiful Bill. Aaron, do you have any thoughts on that?
Yeah, I think so. A couple things that you may be aware of in the Big Beautiful Bill that are really interesting and will impact structures. So on the buy side, obviously buyers are typically, when they think about taxes, they want to get a structure that's going to be treated as an asset deal for tax purposes, so that they can get a basis step up in the assets, and they can write that off over time to increase their after-tax cash flows. The big kind of line item in the Big Beautiful Bill is that 100% expensing is back, right? So that's a big deal for buyers. They're going to want to take advantage of that and help them increase their returns, at least in the first year, based on that. Now, important to understand, many of you probably understand this already, but that's obviously a deferral issue from a tax perspective, right? You write off your basis, that means you no longer have it. When you sell it, you've got a larger gain, and sometimes at ordinary income rates. But that's buy side. Sell side, something that is really interesting that happened is the changes to the qualified small business stock. If you're familiar with qualified small business stock, historically what it's been is that if you have stock that qualifies, you would get a gain exclusion up to 100% on the greater of $10 million or 10 times your basis in the stock. It has to be a C corporation. You have to have held it for more than 5 years. There's a number of requirements. But that could be a huge tax benefit, right? I mean, if you're a founder that set up your business and you've got your stock at zero basis, you could sell it for $10 million, pay zero tax. If you're an investor and you hold qualified small business stock, you invested $30 million into the stock, you could sell it at $330 million and pay no tax, right? So these are massive tax benefits. And what the Big Beautiful Bill did was it loosened the requirements to be qualified small business stock. So used to, and this is, by the way, just for stock that's issued after the effective date of the bill. What it did is it shortened the holding period. So if you have held the stock for 3 years, you can get a 50% exclusion. If you've held it for 4 years, you can get a 75%, and you've held it for 5 years, you can get 100%. So you can sell earlier than you used to. You can also qualify more businesses. One of the requirements to be qualified small business stock is you had to have 50 million or less of aggregate gross assets at the time of your investment in the stock. Now that's 75 million, and it's indexed to inflation, so it's going to continue to rise. And then the other really big thing is that the benefit now is much bigger than it used to be. So instead of it being the greater of $10 million or 10 times your basis, it's the greater of $15 million or 10 times your basis. So from a sell side perspective, I would expect people who have this benefit, we're going to have the same tensions of, is this going to be a stock deal or is this going to be an asset deal? And people who have the qualified small business stock are going to be in a much more insistent position on saying, I want it to be a stock deal so I don't lose these tax benefits.
Yeah, I totally agree with that. I'm personally involved with a partnership we set up where I'm a co-founder in June, and we are ignoring that. We know it's an IP-based company, so we're setting it up as a C Corp. We didn't think we were going to hold it for 5 years before, and as you mentioned, it's after the date of enactment, which is July 4th, which is a pretty easy day to remember. So that $15 million gain exclusion instead of 10 million is huge, but we also I'm going to see a lot more interest in what we call taxable trusts as opposed to grantor trust, taxable to the grantor. Every taxable trust, let's say you have 5 kids and you set up a trust for each one of your 5 kids, now you can get 15 million times 5 of total 0% tax if you hold it 5 years. It doesn't get much lower than 0%, but having the 3-year cliff now for a 50% exclusion is pretty attractive too, particularly if you don't know if you're going to want to hold something 5 years. And there's always been the ability to roll over the gain if you hold it shorter into another qualified small business stock. We haven't seen a whole lot of that lately. I think we're going to see more of that, but I think this is going to be a huge structural issue, and we didn't really see this coming. It was in neither the original House nor the Senate bill, but they put it in the last negotiations and adopted it in the Senate bill, which is what got passed. So that's going to be a home run, I think, for a lot of people. The $75 million asset deal is also affecting another business I was in that was probably $60 million of assets, coincidentally, and thank God they picked $75 million because we can bring in new investors now, and it's from the date you acquire it from your initial investment, not when the company is formed. So the initial investment, if it qualifies as C Corps. And again, it doesn't qualify for every business. It's still, we were hoping that those of us in the professional services business, the AICPA, the American Bar, they were lobbying to expand to include professional services. It's generally not available for law, health, accounting, professional services, but any kind of manufacturing. And then I'll also pick up on something you said about the manufacturing, and this is more for the buyers and the private equity people out here who already hold companies. There is going to be a lot of incentive now to invest in the U.S. In addition to the bonus depreciation, something we've never had before, we get an immediate deduction for construction costs of manufacturing facilities in the U.S., only in the U.S. And there's going to be a lot of guidance and regulations yet to come. I see a lot of games being played. They're already saying that, you know, the portion of your building that you build that's used for administration is not for manufacturing, but if you build a $10 million manufacturing facility, instead of being written off over 39 years, it's going to now be immediately expensed. That's going to be a home run for anybody that was planning expansion in the U.S., and it's only for manufacturing, too. So I think that's going to be a stimulus to stimulate. And maybe the foreign investors haven't come in yet because they haven't woken up to that. It's only been in the law for 12 days now. But at some point, people are going to invest heavily in U.S. manufacturing, so I see that as a big boon to the economy.
Great. Greg, also, you've always been an advocate for early and often tax planning and really engaging with owners and families up to 3 years before a liquidity event. What are some of the reasons for this, and why is this more important than ever?
Yeah, I think you heard this, if you were in the sessions yesterday, you heard this throughout. I think Lindsey and I were talking about this and a lot of others. The investment banking community is realizing that the earlier you get the tax planner involved, the better. And I'll give you a real-life example that just happened last week. And you wouldn't think these kind of things would happen. But have a new client referred to me. He's an MD doctor out in Los Angeles, and he's never practiced medicine. He's an inventor. He's got a cancer treatment that's got 43 patents. They've raised $30 million. They're raising another $10 million now. They've got a very well-known hospital that's signed on to do $10 million of research to get it through the final FDA trials. Long story short, this gentleman only owns 30% of the company, but in 18 months, he's expecting personally about a $300 million liquidity event. He's done no planning, no income tax planning, no estate tax planning. Right now, based on what his offering is for his third round of investment, I think it's a B round, the company's valued at $100 million. That's pretty darn good. But if he's thinking of what he really thinks is going to happen in 18 months, it's going to sell for $1 billion. So literally with planning right now that we could do, we can probably get 200 to 250 million of his 300 million totally outside the transfer tax system forever, which is a pretty strong statement. You multiply that by a 40% tax rate, and that's pretty valuable. If we get within 6 months of that transaction, that ability's gone. It's impossible to value something less than $1 billion if it sells 3 months later for $1 billion. It's pretty simple. But that's an example. Also, a lot of the planning, most of the planning I do for income tax planning involves multiple entities that have to be set up. And we're talking about, you know, trusts that can go on forever. People need to spend time on that. They need to spend a good year in the planning phase, and they need to do it before they enter into the contracts with the investment bankers to help shop the company. Because any of you in investment banking and any of you in private equity know that once you get in within roughly 6 months of a deal closing, that's totally time-consuming to the business owner. They don't have time to focus on this planning. So I really push people to do this planning and what I call the calm before the storm, before the exit is planned. I'm already working on 2026 exits and trying to do some things with some that are supposed to close before the end of the year, but it's pretty darn difficult when you get within 6 months of a transaction. That's a message I've been preaching for years, but I'm hearing it more and more and more.
Any other thoughts on early planning?
So, Greg, I'm going to come back to you and say that's right. Adding entities, adding new trusts, et cetera, is important. But I also think for clients who are thinking they're going to sell at some point, they need to go through what we call legal entity rationalization, where they review their entire org chart and look at what is extraneous out there. Is there, an entity that you check the box on that you wish you wouldn't have? At this point, are there entities that are LLCs or other pass-through vehicles that you prefer to be a corporation at this point or when it sells? These are the kind of conversations you should have with your clients early. And like Greg and I talked about earlier, I've been telling my clients this for 15 plus years, come see the tax people early so we can do some pre-acquisition structure.
So what are some of the most common tax pitfalls you see sellers face in M&A, and how can advisors help mitigate them early?
So for me, the thing that comes up all the time is S corporations. If you've done any work in middle market M&A and you've got a target S corporation, invariably there are problems with them, right? These get set up. I don't know if we have accountants on the panel. Accountants set these up because they want the payroll tax savings, right? And that's fine, but usually it's kind of set up, and then they let them run with it, and they don't really understand what they're dealing with when they have an S corporation, what the restrictions are, what they can and cannot do, and almost every deal I've been on with an S corporation, we've identified some issue where there's a risk that it is no longer an S corporation, it's a C corporation. That is a huge issue for a buyer to stomach when they look at it and say, all right, well, maybe this entity that's been around for 20 years actually owed tax for those 20 years, right? So that's a big problem. Usually, I would say if you have an S corporation and you want to get that payroll tax savings, it's fine as long as you know what you're doing with it moving forward. And anything that you would want to do later can be done. We can restructure in ways, F reorganizations and other things that are going to allow the flexibility you need that you wouldn't have with an S corporation typically. But I usually push people away from S corporations just because there's such a headache in M&A.
Any other thoughts on tax pitfalls for sellers?
I'm going to mention something that's really not a tax pitfall, but one of the things I've been doing this a long time, like 4 decades, and 20 years ago, when I was working with a seller, it really 80%, 75% of the time started out where they were trying to just transition it to the next generation. What we're seeing now, it's almost flipped, where we're seeing about 75% of the people end up, and they may not start. So it's the mental preparation of thinking about a sale. We're seeing the next generations that just either don't want the business, are capable of running it, don't want to do what mom and dad did, any number of things. So I'm seeing 75% of these things turning into sales. But the reality is many of these people go in thinking they may just be doing estate planning, and they're not mentally prepared to sell. And it comes up in the middle of the planning that they realize and have that aha moment, I need to sell this thing. There's nobody to take this over. And whether it's the ESOPs that we heard about yesterday, which is great if you want to leave it to the employees, or whether it's an exit plan like the other things I work on, it's the mental preparation that I find bogs down deals. I'm dealing with a situation right now, 2 brothers can't get along, they each own 50%, one of them wants to sell, one of them doesn't. And these aren't tax things, it's just life, right? And family dynamics is the biggest thing, so it's not really a tax thing, but it's about 50% of what I do is amateur psychology, so that's the one degree I don't have.
Same, Greg, same. Yeah. How about in transactions involving rollover equity? What are the key tax considerations sellers should understand?
Yeah, so I'll start on that. I think anytime you're talking about rollover equity, the goal is always that rollover equity is going to be tax deferred, right? You want to receive it, not pay tax on it at the time because you don't have cash for it, obviously. So important to understand that there are only certain structures that allow for that, right? You can't just say we're going to give them equity and it's going to be tax deferred no matter what. You have to be working with an advisor, as we say, get them involved early because sometimes this is going to be, sometimes there's some challenges to how to come up with this, but usually we can get it done and it's not really that sophisticated. Important thing to understand about rollover equity, though, and the tax consequences of receiving it, is that certain structures that allow for a rollover equity have a different basis recovery rule than other structures. So I'll give you a numerical example to kind of illustrate this. In some structures, you get to kind of use your tax basis pro rata against the cash part of the transaction to offset your taxable gain. Other structures, you're required to be taxed 100% on your cash with no basis offset until you've used up the entire gain. So what that means is if you had a $20 million business that's being sold, you have $10 million of basis in it, and you're selling 75% cash, 25% rollover equity. In one structure, you might be able to use your $10 million of basis, 75% of it, against your taxable gain. And the other one, you might pay 100% of your tax, just as though you'd sold it all for cash, right? And it's still, quote unquote, a rollover structure, tax deferred, but it's a very different tax outcome. So it's important to be aware of that. I had a deal last year, actually, where we started in the more preferable one, and then for a variety of reasons, the buyer came to us and they said, hey, we want to tweak this, we want to tweak that, and it was a 10-minute conversation that went something like this. That's fine, but that changes our basis recovery rule, and so we need to make these additional tweaks and to make sure we're not in the less favorable rule. 10 minutes, save the client $2 million, right? So this is very nuanced and very, kind of sophisticated stuff, but important to understand, you need to have the right set of tax advisors helping you when you're dealing with rollover equity, because it's not as intuitive as you might think.
Another big change that really involves rollover of a different sort is the changes they made in the OBBA to the qualified opportunity zones. We've seen, these came in 2017. They were pretty popular for the first 3 years because they allow deferral on most of the gain if you invest in certain qualified businesses with your rollover proceeds, but it only defers the gain till 2026, which is next year. So you haven't seen a whole lot of interest in this the last 2 years. One of the last-minute changes that was made in the Senate bill, which is the bill that got passed, they kept that rule in place for any deal that's done this year or next year. So anybody that was contemplating qualified opportunity zones, and I'll talk in a second about why I don't see them used as much as, probably they're used more than they should, to be honest, and I'll explain why. Most business owners who are selling their lifelong business and they've run it 20 or 30 years, they have a hard time investing all those proceeds into a business that they don't run, they don't operate, maybe an industry and a geography they have no knowledge of. It's the same thing with 1031 exchanges in real estate that we've seen forever. Unless you're in the business of real estate, do you really want to put all your eggs in the basket of an asset alternative class you don't know? But if you do use it, we're going to see a lot of deals that are going to be deferred until 2027. That's something you may hear if you're involved with selling businesses, because the new rules kick in only in 2027, and they're going to allow a 10-year rolling investment format. They've made it permanent. Nothing's permanent until the next administration comes in. We all know that. But supposedly now you can invest and get 10 years or more of deferral and gain elimination by investing in qualified opportunity zones. A lot more guidance and regulation will need to come out, because this was literally a last-minute change that they put into the bill. But I think you're going to see some people who are planning on there being a permanent extension or an expansion of the opportunity zones wanting to defer their deals into 2027. We're going to see a lot more installment sales. We're going to see a lot more seller notes where they might be able to defer some of the gain into 2027. So that'll be things that I think you'll see coming up over the next year.
So this is maybe kind of basic, but maybe you can just explain to us how advisors can help clients distinguish between capital gains treatment and ordinary income treatment in deal proceeds, just generally speaking.
Most things that involve depreciation are just deferral things. You're accelerating deductions, but you're going to recapture it when you sell it, and it's generally going to be ordinary income, and people forget about that. Particularly, I've had so many real estate clients over the years that when they finally sell out their whole portfolio, many of them hadn't paid tax for 20 or 30 years using all the depreciation. Now they've got this massive gain when they sell out their whole kit and caboodle, and so much of it's ordinary income they don't realize it. And that's one of the things that, I think a couple things that changed in this act that are not changes, those are the most important things to me, because now we have actual stability. We've been fighting for 2 years listening to the Democratic and the Republican proposals. Then we fought for the last 6 months just between the different House versions of proposals. So now we have stability. We have certainty now with the 21% corporate rate. That's not changed at all. There was discussion about raising it to 25%. We've got stability now with the 37% ordinary tax rate, which is not historically low, but I mean, it's been as low as 35, 33% in the past. But it's pretty low. We're going to see a lot more people doing Roth conversion planning, things like that, because we have stability. And I think the other thing that didn't really change, which is particularly important in my area, we've never had a time in my 40-year career to do estate planning. We've now got a permanent $15 million per person gift and estate tax exemption. That's the gunpowder we use for the planning. They didn't do anything to attack all the things that have been in the headlines for 2 years, particularly with the Democratic administration. They were talking about doing away with valuation discounts, grats, installment sales, everything you can think of. They didn't touch any of that. And now we have permanence with, for a married couple, 30 million exemption goes a long way. Do the estate planning now while we have certainty. We have certainty for, I guess, at least 2 more years. And we've never had better opportunities to do that in my career. So I think that's going to be another reason people need to start planning now for an exit in 26 or 27.
So Greg, I think that goes back to what I mentioned earlier, some predictability for us now. And that gives, as you noted, a lot of opportunities for estate planning for our clients.
So what are some tax-related red flags that advisors should catch during due diligence?
First of all, I want to go back to something I mentioned earlier, is looking at the structure to make sure that there are no entities out there that are going to trigger any foreign taxes, any regulatory reporting requirements that you weren't expecting, and all of this is going to come out in your diligence. You have to have somebody who's going to do a very thorough tax due diligence when you're looking at a new transaction.
I think you use the term entity rationalization. Similarly, I think anytime you're going to market, right, the advice you're going to get from your legal advisors is we want to have the company be as clean as possible when we go to market. Entity rationalization, I'm assuming, is talking about making sure you're as tax efficient as possible. There's also a lot of cleanup that needs to happen, obviously. So, sales taxes become a really big issue. If you're selling in multiple states, very often there's limited compliance with what that should have been happening with all these jurisdictions, and that becomes a big issue. So if we can clean that up, any kind of aggressive tax reporting positions, we want to at least know about it before you're going to market so you can, paint the picture for the buyer that you're looking for. I had a deal earlier this year where there's not only all the S corporation issues that we had alluded to earlier in this conversation, but they had also had a shareholder of this S corporation who had gifted 50% of the stock to one of his employees, and didn't report it as a gift, obviously, but they figured that was the way to make that non-taxable. Turns out that's not true. And it was a huge issue in this transaction, right? It delayed everything because there was these multiple rounds of discussions with the buyer about how are we going to value this gift? What are we going to do in terms of amending all these tax returns? How are we going to limit this risk? And if that had been dealt with before it had gone to market, it would have been, right, if the client allows you to kind of clean up and do a self-scout, that goes a long way with taxes.
Should have called it a tip. Those are tax-free.
One thing, it's a small thing, but it can be big. I don't do as much due diligence on transactions as I used to, but I've been speaking on this subject here at AM&A for 2 years. The employee retention credits, it's amazing how many deals I see where it's not even addressed. Now, this was 100% of the time back in 2021 and 2. Most of the law firms have gotten familiar with it. But is that on the books as a receivable? As you all know, the IRS quit making these refunds all the way basically till the beginning of this year. I did hundreds of these for clients over the last 3 years and wrote opinions on them, and half of my clients still don't have their money. I had 2 transactions where the buyer was buying assets and he bought the receivables. This is a receivable from the federal government. The buyer claimed it. It was not in the deal. It was a $3 million refund. That's something that got to be on everybody's due diligence checklist, just a word of warning. I mean, you saw it a few years ago with PPP, but that's pretty much over. But these are going to be hanging out there. There's audits going out the yin-yang right now on the refunds. They're clawing back some. So I think that's one of the things that ought to be on everybody's due diligence checklist.
Important point on that, the beautiful bill extended the statute of limitations.
Yeah, it gives the IRS 6 years now to go back and audit.
So also, what is the difference between tax insurance and rep and warranty insurance? And how can tax insurance facilitate a transaction?
Yeah, so I'll jump in on that one. I think, so many of you, I'm sure, are familiar with rep and warranty insurance, kind of high level. The concept there is for risks that are out there, but nobody really knows what they are, right? It's a breach of a rep. Seller thinks it's true, but maybe a taxing authority, if we're talking about taxes, comes in later and audits them, and we find out that rep wasn't exactly true. The rep and warranty insurance can cover that. Tax insurance, I think a lot of people are less familiar with, and it's for a different kind of situation, right? It's for a situation where everybody knows there's a tax issue there. The government hasn't identified it yet, but we know, for example, that maybe there's a busted S election. And so the buyer doesn't want to buy it because it maybe is a C corporation. The seller still wants to sell it, but there's nothing you can do about it, right? It either is or it isn't a problem. And tax insurance is a product that's available now where you can shift the risk to the insurance market. Typically, I think the process there is that you have to have an accounting firm or a law firm will provide some kind of memo to the insurance underwriter saying, we think more likely than not this is the right position. And if they get that, then they'll underwrite the risk, and the transaction can proceed, even though you've kind of got this. Typically, it's going to make the most sense when you have a low risk, high dollar value risk situation around taxes.
Okay, great. Well, we'll be around after this, and thank you so much for joining us today.
Well, that was straight up rich with intel. So much to unpack and so much to implement in your next deal. We have more to come in our next episode. Don't miss it. But until then, go forth and may your deal making prosper.